Let's talk about something that drives traders crazy. You know the feeling, right? You get into a trade, you feel good about it, and then bam, you get stopped out, only to watch the price shoot exactly where you thought it would go. Well, I'm here to tell you that's not bad luck. It's a specific market mechanic, and we're going to break down how you can flip it to your advantage.
So here's the game plan. First, we're going to meet the stop-loss hunter. Then we'll figure out what fuels it, which is market liquidity. After that, I'll give you a super simple 3-question framework to keep you safe. We'll cover how to tell if you're getting a good price, walk through a perfect A-plus trade setup, and by the end, you'll see the market in a whole new way. Let's get into it. All right, first up, the stop-loss hunter. This is all about a major mindset shift. We're moving away from thinking, man, I have the worst luck, to I see exactly what's happening here. I mean, come on, we've all been there. You nail the analysis, you find the perfect entry, you set a smart stop loss, and then boom, price wicks down, takes you out, and immediately reverses without you. It feels personal, doesn't it? Like the market is out to get you.
Well, here's the big secret. It's not personal, it's not random, and it is definitely not a coincidence. What you're experiencing is a machine at work, a fundamental, predictable part of how the market actually functions.
And that machine has a name. It's called a liquidity sweep. Just think for a second. If a huge bank wants to buy $1 billion of something, they can't just hit the buy button. They need a massive number of sellers. And where can they find a guaranteed pocket of sellers? Right where everyone's stop losses are. So they hunt those stops, fill their giant orders, and then they push the price. And that brings us to the fuel for this whole engine, market liquidity. To understand the hunter, you've got to understand what they're hunting for, and more importantly, where it hides. So the million-dollar question is, where are these little honeypots of orders? Where does all this money tend to cluster on a chart, just waiting to be collected? Well, what's so fascinating is that it's all hiding in plain sight. Liquidity builds up in the most predictable places, the places where every trading book tells you to put your stop loss. You know, right above an obvious high, right below a clear low, at those clean trend lines or those classic support and resistance zones. These become magnets for price.
The best way to picture this is as an order pool. So, above a really obvious resistance level, what do you have? You have stop losses from people who are short, and you have buy stop orders from people trying to trade a breakout. That's a huge pool of buy-side liquidity. The reverse is true below a support level. The market is constantly drawn to these pools to fill orders.
Okay, so theory is great, but how do we actually use this information to not get run over? This is where we get practical. I'm going to give you a new toolkit, and it's just 3 simple questions. That's it. Before you even think about clicking a button, you need to answer these 3 things. Number 1, what's the big picture telling us? Number 2, is the short-term action agreeing with that big picture? And number 3, are we getting a good deal? Let's break them down.
Question number 1 is all about momentum. This is your North Star. And the absolute best signal for real momentum is something we call a break of structure. That's when price makes a powerful, decisive move past a previous major swing point on a higher time frame, like the daily or the 4-hour. That tells you which way the big money is flowing. Now, this might be the single most important distinction you'll ever learn. A real break of structure is when the candle body closes firmly past that old high or low. That's confirmation. But if only the wick pokes through and the body closes back inside the range, my friend, that is not confirmation. That is a trap. That is a liquidity sweep designed to fool you. Now, we're going to jump to question 3 for a second because it's all about value. You wouldn't go to a store and buy something for $100 if you knew it was going to be on sale for $50 tomorrow, right? Trading's no different. It's actually a super simple concept. Just take the last major price swing from the low to the high and cut it in half. Everything in the top half is your premium zone. It's expensive. Everything in the bottom half is your discount zone. It's cheap. And that line in the middle, that's equilibrium or fair value. Big institutions are smart shoppers. They want to buy low and sell high. So if the overall trend is up, they are not chasing price way up in that premium zone. No way. They are patiently waiting for price to pull back to come down into that discount zone before they start buying. Your job is to think and act just like they do. Okay, let's put it all together now. This is where the magic happens. We're going to see how our 3 questions come together to create a true A+ setup. So first things first, we look at our big map. We've got a clear break of structure to the upside. Momentum is bullish. There is zero doubt about the direction we want to be trading. We're looking for buys and only buys. Check. Okay, now we zoom in. This is question 2. Does the lower time frame agree? Yes, it does. We're seeing price respect key levels and start to show signs of strength, confirming our higher time frame bias. The little picture matches the big picture. Check. And finally, the last piece of the puzzle. Where is price right now? Has it pulled back? You bet. It's trading deep in our discount zone, well below that 50% equilibrium level. We are officially getting a bargain. Check. And because we got a yes to all 3 questions, check, check, and check, we can confidently label this as an A+ trade setup. We're not guessing, we're stacking probabilities in our favor by aligning with momentum, timing, and value. So, to wrap this all up, let's talk about what this really means. This isn't just a strategy, it's a whole new way of seeing the market. It's about trading with the flow, not fighting it. Look, the main takeaway here is that we're getting out of the prediction business. We're not trying to be fortune tellers. Our only job is to figure out where the market is going to go to get its fuel, where it needs to go to grab that liquidity before it continues on its journey. We're just hitching a ride. So I'm going to leave you with this one question. The next time you pull up a chart, what are you going to see? Are you going to see a simple double top? Or are you going to see a giant flashing pool of buy-side liquidity just sitting there waiting to be swept? Because I promise you that one little shift in perspective, it changes everything.